Hello and welcome to the big picture. It's being dubbed as the Manic Monday as the BSE Sensex crashed by 1,625 points, which is the biggest ever fall in a day in points terms. It was not just the Sensex which crashed, but also both the small cap index and mid cap index. In percentage terms, the fall of these indices was higher than that of the Sensex. In Asia, after China, the Sensex was the worst performing index today. Shanghai Composite was the worst with a fall of 8.5%. A couple of hours back, as the Wall Street opened, the echoes were felt there too as Dow Jones crashed by 1,000 points, with similar situation in European markets too. In India, as the worst ever crash was happening, the rupee also fell to a new low, hitting 66 rupees 62 paise to a dollar. The fears of the Chinese economy slowing down and the last week's devaluation of the yuan is being seen as the cause behind this Manic Monday. We will discuss today what is happening to the stock markets almost around the world, what is further in store, and how India is going to be affected, even as rupees 7 lakh crore is estimated to have been lost by the investors today in India. And also if China is the only cause for this disastrous day. To discuss this, I have with me Ajay, former Secretary, Ministry of Industries and Commerce, Government of India; Srikanth, Kondapalli, Professor of Chinese Studies at the JNU; T.K.Arun, editor Opinion at the Economic Times; Dhirendra, Kumar, Head Value Research; and Professor N.R.Bhanumurthy, Member, National Institute of Public Finance and Policy. Welcome to all of you. Mr. Dua, just last week we were discussing about the devaluation of the yuan and things like that. Nobody expected this kind of a crash.
Yes, I would agree that this is rather unexpected. Not the fall by itself, but the magnitude of it.
Exactly.
However, we've seen in terms of percentages bigger falls in Sensex in the past, early 90s. I think a 12% fall once in 92, then an 11% fall in 2005 or 2006. The fact of the matter is that something over the weekend, data which come out, etc., has certainly pulled down the stock markets. And to my mind, 2 or 3 things seem to have happened over the weekend. One was data coming out of China, economic data, particularly about manufacturing index, that the growth had slowed down to something lowest in the last 75 months.
75 months?
That's 6.5 years almost. The growth had never been so slow. The PMI, the index for purchase managers index for China, was as low as 47.1% for August data which came out yesterday. And this was even lower than the July data, which was 47.6. And as you know, anything below 50 in PMI is considered a red flag. You got to be worried about it. On top of it, the crash in the prices of the global prices of oil, crude oil.
Right.
That data not emanating merely from China, it fell. WTI, the Western Texas Intermediate, that index brought the price down lower than $40 a barrel.
Right.
As a reduction of 1.9% over the weekend. Third, I think the data which is come out of the US itself, that US also hasn't grown so well in July. The data for US is of July, not August. It didn't do so well as was expected. The manufacturing index is down, and so is employment down, and some very weak signals this time that the Fed may not actually in the US be raising the rates, which it had been talking about for some time. Okay. I think a cumulative effect of all this has been what we felt in the stock market and also in the Indian currency of most currencies which are linked to the dollar.
Okay. Arun, the Sensex crashing is something, and then along with that the mid cap, the small, it's a complete loss across the board as far as Indian stock markets are concerned. How has that happened? How did this happen?
See, the world is awash with liquidity.
With? Liquidity.
Ever since the US, thereafter the European Union and Japan started quantitative easing, there is very cheap money available
Floating around.
Yeah, floating around. So markets are up way above their justified valuations based on realistic returns, perhaps across the world. So is the case in India. But Indian fundamentals are sound. Our fiscal deficit is actually helped by this slump in commodity prices. Our inflation is under control. Our current account deficit is around 1.5% of GDP. So our economic fundamentals are absolutely sound, and they will reassert themselves going forward. So I wouldn't worry too much about today's slump.
You wouldn't worry?
No.
Okay. Dhirendra Kumar, would you also not worry?
No, not at all. In fact, yes, there is something worrisome that a free fall of 10% across the board, across all kind of indices, this itself can scare investors away. And that has been one of the brightest spot, a very pleasant change that has happened in the Indian market, that domestic investors started coming back to the market again in the last 6-8 months. So all the new investors who have come into the market, they can get quite scared by a 5 to 10% fall across board overnight. But I don't think fundamentally there is much of a concern. I think we are, and by the time the sanity comes back, people will realize that this is the only game in town for global investors. At the same time, we are relatively in far superior position.
Sorry to intervene. Global investors are supposed to have taken out 8,500 crores in the last 3 sessions.
Yes, I don't think there is anything unusual about it. Global investors, whenever we have seen, it has happened. Foreign investors have been in India since 1994. And we have seen such kind of situation. If you remember, in 2004 we had a free fall on a day which was about 10%. So I don't think there is anything unusual, but yes, fundamentals do drive markets over time, and there could be, yes, there has been panic. It is not good for individual investors who are not experienced enough, and even foreign investors, they are very much an integral, they are a key driver of our market. And if they continue to remain in the same frame of mind as they are, but I think it's just a matter of time. What we saw in the US market on Friday, what we saw early morning today in China, I think it's a fallout of that. Equity investors tend to act in a manner which sometimes look insane, but sanity comes back very quickly.
It actually looks insane. Bhanumurthy, are the fundamentals? Are you not worried about the fundamentals?
Well, see, there are something like short term and the medium term and the long term. In the short term, I do worry a little bit, particularly we really don't know how much time it's going to take for the global financial markets to stabilize. More so the way we have seen today, the Dow Jones losing 1,000 points, within a matter of 3 minutes.
Yeah.
That shows that I think still things are not really over. But in the short term, again, the concern is more on the rupee depreciation.
Exactly.
Where we have seen a sharp depreciation of rupee to 66 plus, 66.5 or 62, something like that. That will have a much bigger impact. I mean, that is a more worrying factor for the short term. But in the medium to long term, I agree with other panelists. The macroeconomic fundamentals of this country is very strong. And as always, we have been talking about India, China being a competing destinations for foreign investors for the long-term purposes. Now that China is still in a bad shape, we really don't know how much time it's going to take in terms of cleaning the books, both in terms of the real sector as well as the financial markets. I guess India is the only destination left.
So India is going to be a gainer, you're saying?
Yes, I think so.
Okay.
Yeah. Just say something about currency.
Yeah. No, we'll come back to the currency issue. Let me get Srikanth.
Just one small, the biggest worry, I mean, what we have seen today also in the Indian oil companies,
the stake sale,
OFS, the particular share for retail investors not been unsold today. That means still the retail investors are worried more than other long-term or
yeah, that's what
institutional
Kumar also was pointing out. Srikanth, you know, as far as China is concerned, last week we were discussing the devaluation. In fact, you made this point that, you know, they may go in for further devaluation and things like that. That has not happened, but the kind of worry which people across seem to be having about China's economy, do you think those worries are justified? And is that the reason why this has all happened?
I think so, and there are various other macroeconomic adjustments going on in China. For instance, there is the shift from the manufacturing to the consumer, domestic consumption aspects, which is in a way a structural kind of adjustment they are making as part of the 12th five-year plan. There is emphasis on the service sector, which is also part of the 12th five-year plan. You know, the devaluation is for the triggering the exports, which have gone down by over 8% in the first half of this year. All this indicates the restructuring is going to be kind of turbulent. So the stock exchanges have emitted those signals of this readjustment. Of course, it's a painful process for those investors, especially between 25 years to 45 years, which is roughly about 70% of the investors, new investors, who have joined in the last 2.5, 3 years. I think that is going to be a more painful kind of readjustment for these new investors.
But Srikanth, you know, some people are saying that China is not really trying to regulate this fall which has happened in the last, you know, today is the worst, but, you know, it has been going on for the last few days. Is that a deliberate thing, or what is their plan?
Well, there has been this panic reaction for a series of events. The IMF had indicated that the renminbi will not be made, or it will take some time to be made as a universal reserve currency. I think that has also led to this panic reaction, what is in the Chinese press called as Black Monday. I think there is a huge impact on the Shenzhen as well as Shanghai stock exchanges.
Okay.
Of course, the Chinese government is trying to indicate that they will put down this Black Monday event by pumping in more money, especially pension funds. Secondly, they are stalling some of the state-owned enterprises not to sell off their shares, etc. So I think there has been a strong reaction from the banks,
okay,
from the state-owned enterprises.
Okay.
Yeah.
Dua?
I think
you share their thoughts that, you know, short term there is a problem, but mid-term and long term.
I think we are probably underestimating the impact.
The macroeconomic fundamentals are strong. That's what
let's not underestimate what's happening around the world, starting with China. It doesn't look like the Chinese will be able to achieve the 7% targeted rate of growth of the GDP. And that
will have a ripple effect
all over, almost everywhere in the world, because the Chinese economy is a large economy. 11% of the global share in terms of PPP is what GDP virtually works out to. And the prices of whole lot of commodities, oil, coal, crude oil, and those kind of aluminium, those are the Chinese were one of the biggest demandees for that kind of stuff.
Importers of these things.
And you would see if the Chinese demand slows down, we might see a recession in the world, particularly if it also leads to competitive devaluation. Currency war, if it starts, I fear that this is what we saw in 1929 when we had the Great Depression, everybody wanting to protect their exports or boost their exports, and without realizing that if everybody wants to cut down on imports, that the imports only, global imports only aggregate to global exports.
Raghuram Rajan mentioned this sometime back in London, and then of course he took back his words.
No, I go back to Ruchir Sharma. Right. He's talked about what might happen if there is a Chinese bubble, bubble bursts. I wouldn't call it bubble, for after all 20 years they did have almost a double-digit rate of growth. That it is not sustainable over time. Would you like to react?
No, I am not that scary.
You are not so pessimistic.
You are so pessimistic. All along, if you have seen for the past 1.5 years, if you take any of the public policy statement, India has been trying to depend more on the domestic demand, and it's agreed that there is not going to be an external demand, at least for 3 to 4 years down the line. So we are not really worried whether China is going to grow at 7% or 8% or 6%. So given that, my view is that because of this Chinese growth slowdown, what might happen is there may be some kind of reverse globalization might happen. We might try to protect ourselves in terms of creating some kind of domestic demand driven growth rather than export led growth. I think that might happen. And I guess
that might happen. For that to happen, there has to be a good policy, decisions being taken.
Yeah, I think we have been seeing, to be fair to the current government, we have been seeing good policies for quite some time. I mean, since last year, there are many positives happened. Of course, there are many more to come, but there definitely many positives happened over a period of time. Okay. But just to add, if you look at other countries in the world, like US, of course, China, we don't know how it's going to play out on the US economy, but we do see that US economy is definitely in a recovery path. So I think it's not all that bad at the global situation.
Arun, would you agree with that?
See, let me begin with this currency thing.
We have to come to the currency.
See, there's a dollar
because last week also we were discussing, last week we were told the devaluation of yuan has affected the Indian currency. Now this also has affected.
See, there is a dollar illusion. We are all so focused on the dollar, we fail to see the real effective exchange rate of all these currencies in question. The yuan is 20% stronger than what it was in 2012 by the trade weighted real effective exchange rate. If you look at the yuan against 3 currencies, not just the dollar, but against the dollar, the yuan and the euro, then this kind of the degree of depreciation or overvaluation changes completely. The rupee is seen to have depreciated as compared to against the dollar against last year. If you look at this basket of 3 currencies, we have actually gained some 7.6%. So both the yuan and the rupee needs to shed some value against the dollar in order to actually achieve the real trade weighted effective exchange rate. So some of this correction, I think, in my opinion, changes is actually a correction.
Actually, you see the rupee going down is actually a correction.
It's a correction.
No, but do you agree with that? It's correct. I mean, it's part of that correction. But my point is that, we all know what the rules of the game. Why can't India and China start trading on their own currencies? I mean, keep the US dollar and euro separately. I mean,
that could make a huge change.
Yes, I mean, I think we can minimize that.
I think
I'll come to you, Dhirendra.
Yeah, we need to keep in mind that our exports to China, $12 billion, is a minuscule. Our imports from China at $60 billion are huge for us.
Same as US, sir.
The difference of $48 billion in a trade of $72 billion is a 66% deficit in our favor, against us. The fact of the matter is, if the Chinese economy slows down, we might correct this to some extent. But the fact is, the Chinese become more competitive elsewhere in the world. Our exports will suffer all kinds of things. So the global rate of growth slowing down because of China slowing down is a real threat to our trades, our balance of payments, as well as our GDP.
Okay, Dhirendra, would you also look at that? One second thing is what has happened today, or what has happened in the past few days, and especially today, the crashing of the stock markets in India. Is it only because of the China factor? Are there no internal factors which has caused this crash?
Yes, it is. I would say that there is never a single factor. There are a combination of factors, but yes, China is the most prominent factor. And I think I'm looking at it in a very positive way. What has happened to the Chinese market in the last 3-4 weeks, and the way the government has reacted to clamp down on the kind of the kind of investors who can't sell their stocks, the kind of inflows getting artificially created, firstly banning the kind of sale by in the domestic market, that actually reflects very poorly on the way the Chinese market is structured. We also have to look at what kind the transparency of the market, the way investors know about a market, what it is made up of, how it will behave. I think in India turns out to be a real market with great legacy of great tradition and a culture of market, howsoever narrow it be. Of course, the size of the economy is very is not comparable. We are still working on Make in India, or trying to make it work, the Make in India campaign. We are getting started with it, while they are working hard to ensure that what they produce, they have a market for that. So in that sense, I don't think on the real economy we are comparable, but I think global investors as a destination which attracts investors, I think investors will clearly be making a choice in terms of where their money is what will be the right destination. And what has happened in the last 3-4 weeks, I think reflects very poorly of China.
Okay. Srikanth, what are the other plans of China now? How will they regulate? Or are they worried about what is happening? Or is this part of their correction process also?
I think this is the larger part of the readjustment in the stock exchanges as well. If you carefully look at last 1.5 years, the Shanghai Stock Exchange grew at nearly 135% in just one and a half year, and the Shenzhen one was about 185%. So I think this is a kind of mid-course correction that they are making. Of course, there has been a lot of state intervention in the Shanghai and the Shenzhen exchanges, but which state did not intervene in any stock exchange? For instance, Hong Kong in 1997 financial crisis, involved in the stock exchange, which is supposed to be one of the freest market economies. United States in 2008 global financial crisis had intervened in the stock exchanges. So I don't think this is a major issue. I think we will see more of this mid-course correction by the Chinese state. Of course, there has been a lot of concerns, especially for those age group of 25 to 45 who are the fresh kind of investors, new investors who come onto the board. I think this is one key problem for the Chinese to attend to, because that if they have a whole generation of people having a bad impression about these stocks, I think they would learn bad lessons out of this experience.
Okay. Bhanumurthy?
Yeah.
As far as India is concerned, he feels that as far as the currency is concerned, we need not be concerned. It's part of the correction. That's what Arun feels. You also believe that, that this fall of the rupee is something which in at least medium term we need not be worried about.
Well, I think, as I said, at the moment, I mean, if you look at the reaction today from the central bank, it looks like, I mean, we don't need to really worry about the
Raghuram Rajan has said that, we have enough.
Yes.
We have enough foreign exchange reserves. If you want, we'll
as and when
appropriate time we will intervene. What is the appropriate time?
No, I think what he was saying is he is trying to normalize the volatility, excess volatility in the market. And what he's saying is that he's not going to target a value. Rather, it is going to keep the rupee in a band such a way that the volatility, excess volatility will be taken off. I think that's fair enough. And we would see this kind of correction happening on the reverse side also once the global financial stability takes place. And particularly when you see the foreign capital flows coming into the market. Of course, today there was an outflow of foreign institution investments. But going forward, as I said in the beginning, we should expect much more foreign capital inflows, which would strengthen the rupee.
The rupee also.
Yeah. Yes, I think it's a myth, and I use this very strong word.
What is the myth?
That only China and India are competing for the global capital inflows. There are many other countries in the world.
Many other emerging economies.
Absolutely. Emerging, and even Europe. Europe receives much greater amount of American money than any other country in the world. The fact is that there is going to be competition, and the Indian stock market has grown whenever there has been greater FII, FPI money coming in here. You can see it chronologically, month-wise, date-wise, etc. In case the money stops coming or the withdrawals are higher or are high as we saw today, it will certainly impact our currency, and the Reserve Bank intervention will become essential. And it's been happening in the last few days.
Okay.
And it's like all that happened today was the governor said it so explicitly in order to suit the market.
But
Dhirendra Kumar, would you agree with that as far as the RBI's intervention is concerned?
Yes. Yes, absolutely. I think, in the short run, if a lot of investors pull out, and FIIs have been the most dominant participants in the Indian market over the last couple of years. In fact, just about a year ago, FIIs were the only investors in the country. Domestic investors were only pulling their money out, whether it be insurance companies or mutual funds. And only now, it was so much of a headline that EPFO will start investing $1 billion in a year's time. Which was such a big news, and it will be such a small amount to be invested over such a long period that it will be virtually, insignificant. So I'm saying that yes, FIIs are a very significant player, but even for FIIs, India will become a more prominent and interesting destination.
Okay, Arun, very quick last words to you. How long do you think the Indian stock markets will take time to recover from today's shock?
See, let us understand turbulence is going to be a feature of the global financial system and of our stock markets in the foreseeable future. All this excess money that the US, EU and Japan central bank created is floating around. When the US starts raising its interest rates, if not in September, perhaps early next year, again there will be turbulence. So we have to be prepared to see turbulence and money going in and out without any stop. However,
what is the government supposed to do to control this turbulence if it can?
So the
government, RBI?
Yeah, see, government
quickly.
Fundamental economic dynamics. If you can show that we are a fast-growing economy, our investment, the problem that we have overcome, and investment takes place and the economy starts growing, then India will seem to be a positive destination to bring your money.
Okay, I think on that note we need to end. Volatility will continue. That is the essential, part of what we are seeing, and it may continue in future. We wait and watch what will happen. Thanks to all my guests. Please keep watching. We'll come back with another issue on The Big Picture, same time tomorrow.